Hi, this is Randy Finney with the Right Side of the Chart, and today is Monday, May 29th, 2018. In this video, I'll do this for members of the site. I wanted to go over sort of a bigger picture overview of everything that stands out to me right now, and we'll only look at ETFs. So therefore, these are actionable trade ideas. Now, some may or may not offer objective entries right now at this point, but these are the things that I've been focusing on lately. And again, this all ties into what I've talked about, and our theme for 2018, and really at all points in time, you should consider this, and that is asset allocation. Asset allocation, study after study shows that the bulk of the returns of a portfolio, and they're really most of the studies are geared towards investing. But I can tell you, I believe that asset allocation is just as important in active trading, swing trading, trend trading, as it is in long-term investing. So what we're going to look at are a few different asset classes, treasury bonds. We'll look at various commodities, stocks, and that's part of asset allocation. Now, as an active trader, I use what I call tactical asset allocation, whereas an investor might use passive allocation, asset allocation. For example, way back when I was a broker or financial advisor, the old rule of thumb, and again, it was a rough rule of thumb, is you would take the number 100 minus somebody's age, and that's the percent of their portfolio that should be in fixed income, i.e., bonds. Yeah, that's safe money investments. And the reason was dualfold. Number one, the older you get closer to retirement, or you're in retirement, so therefore you can't take the risk that you can as a 20-year-old, 30-year-old that's investing, who can have most or all of their money in equities because they can ride out bear markets and recessions and the business cycle. But as you get close to or in retirement, you can't afford to have all your money in the stock market, because 2009 to 2000, or 2007 to 2009 showed us when the stock market fell by 50%. That's what happens, and therefore, if you're drawing off that portfolio, especially, you probably never made it back. So asset allocation is important, and the other point of that too is the second part is as you get closer or into your retirement years, you need to generate income because you're no longer working. So that's another reason that you should gradually shift more and more money into that. Now, that's long-term investing. Asset allocation, tactical asset allocation is what I use as an active trader. I wear two hats. I am an investor. I have long-term accounts for both myself, my wife, my kids, family members, and I also have, a trading account, and that's where I use tactical asset allocation. So in other words, I was bullish on bonds back here. We've had IEF has been an active trade idea. This is TLT. I added it on as an unofficial trade because we had IEF, which is almost identical. They're just shorter term treasury bonds. The intermediate term, I should say. These are long term bonds. And so we hit that first target right here. Then we went on to hit the second target and reversed right from there. So it was, nice entry, nice exit, caught the entire move, got out, and then I started getting bullish again here, laying out this scenario where we might see TLT undercut that 115 or 116.56 56 roughly, we'll call it 116.50ish support level. Very well defined. We're going back a couple years here, and you can see how many reactions that TLT has had off that level. And then the scenario I laid out most recently was an undercut of those lows, which would pave the way for a bear trap scenario, meaning you undercut support, shorts pile in. Remember, basically, when you're looking at TLT, this is like looking at a chart of TYX, which is a 30-year bond yield, in reverse, because treasury bond prices go up when rates go down and vice versa. So here's TYX. We flip it upside down. These are the long-term, the 30-year treasury bond yield. And so you can see same story. Yields have a resistance level here. Interest rates do, long-term bonds right around that level. And we punched up through it. And those that aren't proficient in technical analysis said, "Oh, great! There's a breakout to new highs. Interest rates finally took out that what is that 3.2 ish level that they've been tapping on for years. So we're going to go long rates or short bonds," and that again proved to be a bear trap. Fewer things are more bullish than a bear trap, which is a failed breakdown and then a reversal. And you can see how impulsive that buying has been. So, part of this too plays into the fundamental scenario that I laid out. This was a technical scenario, and this has played out. Now, whether it's by pure luck or not, the fundamental scenario I laid out was the there is I believe, a negative feedback loop in the financial markets right now, and that has to do with the Fed's, planned trajectory of rate increases. We've already seen the Fed, they've been hiking in recent years, and there's an expectation that they were going to continue to hike at such and such pace. Now, the thing about that is, if as rates continue to climb, or if that trajectory, the expectation of interest rate hikes increases, that then puts pressure on the stock market. The market doesn't like higher rates, especially higher than what's already been priced in. So therefore, that's what happened, I think, when you had this little breakout here and everybody was getting bearish on bonds, bullish on rates, thinking that interest rates were going to go a lot higher and bonds would continue lower. No, the opposite happens. So we had a nice reversal there. And again, technicals speak for itself. You can see this is a pretty significant area. We're coming up on that. This was again my target for this move up. I had this first target here, second target there. You can see that's where rates based right here. Then we finally broke out. My expectation this time around, I think we're going to overshoot this target a little bit. I'm still near-term bullish. We have, as I mentioned here, positive divergence down here, clear positive divergence on the indicators. We're oversold back here. We had negative divergence right here that led to the top. So these are my swing trading time frames. I like to look for, just like with stocks, I look for these divergent lows and highs. We had a divergent low right there, rally. Divergent high, correction. Divergent low, this could lead to a much higher move in interest rates. So like I said, I think I'm sticking with my TLT longs right now. I think there's a little more upside to go. I think we'll break above the top of this range. Let me show you a chart here on the weekly chart for those of you in this one. Here's a trend line that comes off the 2011 lows, a couple reactions right there back in late 2010, early 2011, another reaction there, late 2013. So quite a few reactions. Now, I do see some cross currents, and those cross currents are this. Well, number one, first and foremost, we just recently broke down below this trend line right here. Whether that trend line will continue to act as resistance now that prices are below it. We already had one reaction there. I expect a little more upside at minimum to test that trend line again. That's why I'm still near-term bullish. And I'm actually leaning towards us breaking back above that trend line, coming up here to about that 128.56 level, at least before all is said and done. Now, we may get a little reaction there first. I'm not expecting a straight shot up, but anything's possible. Now, as you can see, I did have divergence here. We had a divergent high right here at this point back in 2016, and those negative divergences certainly played out for a sharp correction, as you can see here, as they often do. And now we have positive divergence right here. So the cross currents are this. Usually you don't get a big divergent high. Almost these divergences are also equal in scope. If you look at the how long those divergences lasted for, they're nearly mirrors of each other. You don't see that often, so it's given me a little bit of pause right there. And this bullish divergence right here comes on the heels of that initial thrust down and that breakdown below that trend line. So again, I'm what I would say cautiously near-term bullish on rates now, but I also think that we're going to be in for something like this. I think we're going to be in a trading range here for a little while within this area here. So the good thing about treasuries, again, if you are using this as either a long-term investor or an active trader might want to start reducing positions, at least not add to a long position here in TLT. Whereas a longer term investor, you're getting paid to stay in TLT because it holds treasury bonds. The rates aren't stellar, but they're steady eddies, and you're getting some kind of interest there. So that's that. Let's just move on from there. Like I said, near term cautiously bullish here, but again, most of the major move that I was looking for, now we're there. We're pretty much at that resistance level now. So it's prudent maybe to raise your stops at this point to protect profits. Or again, if you're an active trader, book profits here. Maybe we go up another 1-2% or so. That's up to you. IEF, that's again, this is an official trade idea that's been on for a while. May 2nd. So it looks like we're going to have another dividend paid out soon, which will reduce our cost basis. We've already had a couple dividends paid out on this one since we've been in it, and it looks good. There's a downtrend line. There's a divergent low. Big move up today. First target we're coming up on. Now, I may adjust these targets to account for the basis. There's two ways to do it. When you're paid dividends, you can either reduce your cost basis. In other words, we went in at 102.30, but when we've been paid out, almost 50 over 52 cents in dividends, that reduces your cost basis. Therefore, we can reduce our targets as well. And I may do that. Let's just keep it simple. For now, let's leave it on there because I'm looking for a little more upside in bonds. I think TLT, like I said, will take that level out. And I think IEF can make it up here to that 103.63 area. Heck, we're already at 103.16 right now. So after printing a high today of 103.17 so far. So looks good. And I'll make a decision whether to leave these longer term targets on or give you my thoughts, even if I pull it as an official trade, because I suspect that we might grind around sideways. Sometimes I like to clean up the trade ideas just to be efficient. But if you're a longer term trader and I see minimal downside, you can, collect the interest or the dividends, if you will. Technically, it's a dividend when they collect the interest on the bonds and then pay it out in an ETF that's considered a dividend, same difference. All right. And this is the bigger picture for bonds, or at least IEF again. You have some cross currents. You did have a trend line right there that was broken. You did have a divergent high. Again, I don't have all these charts aren't completely annotated. I showed it to you on TLT. They're going to look similar. These are just 7 to 10 year bonds, whereas TLT holds 20 to 30 year bonds, so treasuries. But there it is. So you had a divergent high correction, and now we have a divergent low, which is only just starting to play out. So I think we need to pop above this level. That'd be bullish. If we can get above, let's be safe, say about 103.80 or so. If we get above there, we could go quite a bit higher. So that's IEF. And again, it's only a small part of the piece of the pie. That's what this is all about, is asset allocation. It looks something like this. If you take a pie chart, I'll just kind of ad lib it here, bear with me. You draw, the percent that you want to have into bonds. Say I'd have to use a different tool for that. I was going to write the letter B for bonds, E for equities. I can do that with a straight line tool. Actually, is this? No, this is a straight line tool. So there it is. So B for bonds, and then we'll have C for commodities. I need a different tool there, but so that's what asset allocation looks like. And you can even have, REITs or whatever else. And again, this determines, it depends on how aggressive one is. And then with this equity portion here, we can even subdivide that further by going long or short. So imagine if I could make a little S right here. This would be our equity piece of the pie. Let's say that's, I don't know, 40, 50%. And as I go through this video, I'm going to show you quite a few sectors which I think look like good shorting ops, and you can short those. And I've also highlighted sectors that I've been bullish on recently, mainly because of this expectation of a reversal in rates. So we'll get to those right now. We'll start there. XLU, I said if my rate scenario played out, we'd probably see a rally in XLU, which we have. Right there, you can see that these our utilities are very rate sensitive because they pay high dividend rates, and they tend to move very often in line with treasuries. So you can see that rally that we've had. However, we've kicked back to a trend line now, which is resistance. So I think at least for the near term that this run in utilities may be over, and I'm not liking the longer term chart. I just want to say that when I go to XLU, we look at this. You can see this divergent high right here. This is the most significant thing to me on this chart. We had big negative divergence here at this high. We went down and very impulsively. We broke below the primary bull market uptrend line. This comes off the 2009 lows. And then since then, we've been flagging. You can see there, looks like a bear flag. And we broke down. We did have one big green candle. That was that big rally I just showed you when rates recently dropped down and bonds rallied. That was that. But now we're back testing that level from below. Trend indicators are bearish down here. So utilities, they don't look good. I think that at this point in time, it might even be a short. And if you don't have access to short, you can buy SDP. This is the ultra short utilities ETF. That's a way to benefit from falling utility prices. And I believe that's 2 times leveraged. The other one was IYR, the REIT sector. There are a couple names. I mentioned Simon Property Group for one example. Recently, I mentioned that as a long trading opportunity. And REITs have been moving up. They're also rate sensitive. They tend to pay a high dividend. Here's SPG. There's the targets, went up. We're still right around that second target. This was based off this divergent low right here, the bullish falling wedge pattern. But again, I'm not. Uh, my thoughts on the REITs right now, my convictions aren't very strong on where we're going. I'd be a little bit cautious right now. I look at the weekly chart. I see support here around 71.83, and I also see what could be similar to that flagging type action. It's a little bit long for a bear flag, but just keep in mind if we go lower, and if the market falls, typically it takes everything down with it. So if my call for a correction in the U.S. in the broad markets, the S&P 500 is right, you're probably going to see REITs and utilities and just about everything else, including all the other defensive sectors like what is it, XLP, I think. Yeah, XLP, consumer staples. That's traditionally a defensive sector, but you can see it's broken long-term trend line support and it's moving down. So guys, I don't see a lot as far as direct equity exposure that looks good right now. Most of the things I'm bullish on are commodities and bonds and things that tend to move inversely to equities. Let's look at a few other things while we're talking about commodities. Let's just go right into sugar. It's one that I've highlighted recently, looking good. We had this downtrend line right here, big divergent low, and it's continued to move up. And again, I don't see any resistance until at least this 26-27 level. So that's one that looks good. JJOFF, an active trade. I noticed this little funky candlestick right here today. I don't believe this has cleared the stop. I think that's an erroneous print from this quote provider, because when I look at sugar futures, let's do that real quick. I'm sorry, coffee futures. Okay, here's coffee futures. This is a 5-minute chart, and you can see there's nothing even remotely close to what happened there in JJOFF. So we'll have to see if that was. In fact, I can even show you. Let's just go to that chart real quick. I think it might be a misprint on this TC2000 program. Here's a 1-minute chart. You can see it's not very actively traded. That's why these candlesticks. But here's where all the candles are over the last day or two here, right up here. And then we have this one errant print right here. Um, so really that didn't happen in sugar futures. If it happened here, it would have been something that looks like an imbalance at the close or something like that. Or was it today's open? Yeah, today's open. So again, we'll just have to look at that. So as of now, it's still an active trade. I still like coffee. DBA, I'll touch on that. DBA is just a mishmash of various commodities. I've mentioned this one in the past. If you really want to just use a shotgun approach, keep things simple. I like to strategically move among commodities because all commodities are not created equal. I mean, I could be very bullish on any particular commodity at one time, even within the agriculture commodity arena. I mean, you have, metals, ag commodities, you have grains, hard and soft commodities, all different type of things. But DBA has, you can see the percentages here: wheat, corn, soybeans, has a little of everything. But as a longer term play, like I said, I think the outlook for commodities is overall, and I'm talking the longer term outlook for the next 6 months to say 2 to 3 years, I think is more bullish than the equity market. And here's a nice downtrend line to watch. This one looks like it's bottoming. There's a divergent low. Very oversold. It just has to take out this downtrend line, and then I think we move up ultimately here at about the $21 level. But again, you've got a mix of a lot of different things in here. So you can selectively trade those individual commodities. I just showed you a couple. For example, I showed you some that I was bullish on. Here's one that I've mentioned I'm bearish on: wood. And you can see wood broke down. I've covered this quite a bit recently. Breakdown right there on that candle, and then boom, we're starting to sell off, and I don't see anything stopping wood. Might have a little hiccup right here around the 79, 60-ish area, but I think it's going to come down and revisit this long-term uptrend line right here, this yellow uptrend line, which is another, try to give it to you in percentage terms, depends when we get there, at least another 4% or so downside. And probably a lot more if you look at this divergent high. I think that trend line will eventually break. And I think wood has the potential to fall all the way back here at about the 63.25-ish level, and that would be about 20-21% if that happens. Okay, started the video with treasury bonds, which are one end of the spectrum. Those are your highest quality bonds. You cannot buy a safer bond. Um, they're backed by the full faith and credit of the United States government, which can just print money if they want to. They're going to pay back their bonds, no matter what it takes. Whereas on the other end of the spectrum, you have low grade, below investment grade corporate bonds, aka junk bonds. And this is one of two different ETF popular ones out there, JNK and then what's the other one? No, not LQD, HYG. But these are going to be more the junk bonds trade closer to equities because of their sensitivity to the economic cycle. If things start to go down in the stock market, the economy begins to slow. You'll see default rates go up on these bonds. A lot of these companies are just bad quarter two away from defaulting on their bonds, and that's why you have higher yields on those. But therefore, watch for a break of this level. Um, yeah, I don't know. I wouldn't add this as a short trade right now. Plus, when you short junk bonds, you've got to pay the dividends. They kick out a nice dividend. But I just want to say, if you're in junk bonds, if you've been chasing yield, look at this. The stock market's not far off new highs, but junk bonds peaked back here in 2014, and they've been moving lower since. So, and there will be a lot more downside once we are finally in an economic contraction. I can all but guarantee you, you're going to see junk bond prices move a lot lower as default rates spike. Okay, told you I'd go all over the place in this video. We're almost done. We're over halfway through. I am still, despite the persistent downtrend in or the strength in the dollar, which downtrend in the euro, it's really been in the euro falling with everything going on, Italy, Spain right now. Talks of the, problems with the eurozone. This chart looks like an imminent reversal to me. So we've gone lower. There's a very good support level right here. And if you recall back here, a while back, I was quite bullish on the euro, bearish on the dollar, expecting a breakout, which we got, and laid out a scenario. And we had it. We had a back test. I said when we broke out here, I was looking for a back test of this basing pattern right here in the euro US dollar. So we got it. We pushed back up, and then we went up in this bearish rising wedge pattern. You can see down below negative divergences, everything you like to see in a bearish rising wedge pattern. That marked the top. Once we broke trend, and it was a very well-defined trend line. I mean, technicals couldn't be playing out any better. Now, I didn't think we'd come this far without a hiccup. I thought we'd have at least a hiccup, a bounce there. But now we are at that top of that multi-year basing pattern right now, which acted as support here. It acted as resistance throughout 2015, 2016, and we finally had a breakout here, which really launched the rally. So with that being said, we're very overbought right now, or we're overbought. I shouldn't say very. This is very overbought. This is pretty darn overbought. This is just overbought, but sometimes that's all it takes, as you can see here when you look at those overbought readings, especially if the primary trend is up. Okay, I had a brief interruption there, but just back to the charts. I flipped over now to a chart of FXE. If you're looking for trade ideas, and this might not mirror that, this is an ETN, so it's not going to track perfectly, but if you're looking for a trading op, FXE, at least for a counter trend bounce. Now, keep in mind, there was a divergent high, just like I showed you in the euro US dollar pair. We broke down from the wedge. Usually you don't get a one and done type correction after a divergent high, especially on the weekly charts. So what I'm looking at here is at least an oversold bounce soon. I think you can position for that, followed by another thrust down, maybe the second test that level. Maybe we go even lower. It all depends. But at this point, I think the risk reward for the euro is skewed to the long side versus the downside. Anything is possible, so you can take a shot here. We're at 110.74 right now. I think it'd be bullish if it gets back above that 111.70 level. And again, I look at the actual currency pairs more so. The ETNs don't always do a perfect job of tracking the underlying. So there it is. That to me looks like an objective long entry on the euro. And then that parlays into the next one. Gold, I remain bullish on gold. Gold's at this weekly bottom of this triangle or this uptrend line off the 2015 lows right here, late 2015 lows. So this has been the trend in gold. And as long as we're at trendline support, that's an objective long entry. It would really help to see the bullish case would really be firmed up if and when we break above that trend line, the downtrend line, as well as this 130-ish resistance level. That would be a longer term bullish for gold. But as of now, and of course, let me just tell you the bearish scenario. If we take this trend line out, especially on a week, this is a weekly chart, so you want to see a weekly candlestick close in a solid candlestick close, not any little limp below. You want to see a big red candle, and that would probably take us down to the 114.89 level. So until and unless that happens, my expectations are for a reversal here, and probably go on, and even if we just rally up to that 130 level, you're talking, about 6.5 points. Not bad, close to 6%, better than 5% upside in gold. And of course, my preferred trading proxy is GDX, and there it is, same similar triangle type pattern on GDX. Gold stocks have been extremely resilient despite the weakness in gold recently, in the strength in the dollar. Remember, gold is very much a dollar sensitive asset, trades inversely to the US dollar. So we're still going. We're not, we're treading water on this trade, but we haven't been stopped out. And if we get that reversal in the dollar soon, like I expect, gold should take off, and I think GDX will take off as well. So I still like that. And I just recently did an extensive video on the gold mining stocks, highlighting some of my favorites. So you can take a look at that. And then to wrap the video up, some other sectors that I like right now. I made mention in the trading room today that I really, one of my favorite short side sectors in here, there is an ETF for this, are the brokerage firms. And this is actually, the KBW Capital Markets ETF. So when you look at this, here's some of the holdings. It's off to the off this screen, but I have a list that populates the holdings of any ETF that I key in. So you can see here, Morgan Stanley. I'm just going to go through a handful. Divergent high, trendline break, and we're starting to solve impulsively. Goldman Sachs, divergent high right here. I haven't really polished up all these charts for the video, but you can see this one's been clearly moving lower. We had a divergent high back here, and that led to a multi-month correction there. And again, there may be more downside to come. BLK, BlackRock, still has a way to go before this trend line, but this is a key level here, about 506. If that goes, which I suspect it will, more downside in BlackRock. There's Charles Schwab, SCHW, BK. I could go down the line, CME. They're all similar stories, divergent highs. Again, I don't have them all marked up. I mentioned in the trading room today, and I believe I posted the chart as well. One of my favorites is actually the broker that I use for my primary trading account, IBKR. Must have typed that in wrong. IBKR. Interactive Brokers. Yeah, I shorted this one today. I got a price alert here on that trend line break, and it's down almost 5% now. I posted a chart earlier. It's at the first support level here, 74.28 or so, but I think that level ultimately goes maybe a little kickback rally to backtest that trend line if you're looking for an objective entry, or on a solid break, especially closed below 74.28, and I don't see anything slowing that stock down till at least this 65.48 area. So set your target a little bit above there. I may make this an official trade. I'm not sure. Maybe use that ETF that I just showed you, and ultimately it might work its way down here to about the 59.12 area. So my minimum target from here downside is about 12%. With as much as 21% or so downside in Interactive Brokers. And I'm sure there's some other gems out there in the sector. But again, if you are an ETF trader and you want to keep it simple, you want to have the diversity and simplicity of just trading one position to cover the entire sector. And you can go to the website and they'll show you what the holdings are. I just went through some of the top holdings there a minute ago, but that's it. And, the most objective entry would be to wait for this trend line to break. We're almost there now. We haven't done it, but I think it's a matter of time. I'm looking at, the divergent high we had here. Wrong tool. But let me just move on to the next idea. XLF. Well, this started, I've been bearish on the financials. I've showed this chart recently, uptrend line, big divergent high right here. Recently, and those divergences are most certainly playing out. There was our divergent high, negative divergence right there. We set up with a smaller little divergent low right here, which played out well. I mean, this one's really trading well to the technicals. So we had a big bearish divergent high, break of the primary uptrend line. We back tested it for several weeks. rolled down, put in a divergent low, a small divergent low on the daily, which led to this little kickback rally, which back tested the trend line from below. And since then, we've been moving down impulsively lower. So what you want to watch for on the financials, this whole area here, it's not a hard line, but it's I'll box it in right here. These lows right here, you can see that was pretty significant resistance back here, support. So if we take out, to be safe, the recent lows from looks like April or May, that's probably going to spark another wave down in XLF. And again, I just showed you KCE or the brokerage stocks. They're a subsector, if you will, of the financial sector. IHI, medical devices, this is an active short trade, I believe. I put this one up as an active short trade on the site. There's a lot of medical device stocks that look toppy to me. Plenty of downside. It hasn't even broken below this wedge yet, and when it does, I think it's going much lower. Maybe I didn't add that because I don't see price targets on this chart. Maybe I just covered it in one of the recent videos. I don't know. So many charts stand out to me right now. So forgive me if I haven't. I'll revisit this and maybe look into adding that as an active trade idea. Almost done here. A couple more. ITA, this one I did add because I can see the price targets and I do remember that. This is the iShares Dow Jones U.S. Aerospace and Defense Index Fund ETF, ITA. Beautiful chart here. Divergent high, impulsive breakdown, back test, and starting to roll over. In the video that I covered the other day with trade ideas, what led me to that is I came across Lockheed Martin. Beautiful looking chart. And this is where it was in the video when I covered it. Right here, it was back testing this level. The very well defined former resistance, then support, boom, breakdown. Confirmation that it was an important level was that impulsive selling. Then we back tested, failed, back tested again. Doesn't get any easier than that in trading. I mean, maybe the trade would have been stopped out, but like I said, it was an objective short. That I can tell you. It doesn't get any more objective than that. So you short there through the 326.10ish level. So far, that one's dropped about from that back test about 3%, and I think there's a lot more downside to come in that one. And again, that's one of many, or you can just use the ETF. Covered gold, I covered GDX. I just want to say that if the markets do roll over, I can't make a screaming case to short the semis right now. There are some individual semis that look ripe for shorts, but I do believe the semis will most likely fall in line with the broad markets. And let me show you one other thing. Okay, this is just a different variation of the chart, but let me show you this one I've highlighted recently, this potential complex head and shoulders pattern. So we'll draw a neckline right there, and let's just use circles. Left shoulder 1, left shoulder 2. Here's our head. Right shoulder 1, right shoulder 2. See a move down to the neckline. We want to see impulsive move down. Impulsive meaning a lot of red candles, a lot of selling, similar to this, and you want to see an increase in volume. That will help confirm that a right shoulder is being put in, and then ultimately you get a breakdown. And the measured target, you take the widest part of the pattern, which is the head down to the neckline, and then add that to where it breaks down. So that's something to watch. And again, whether the semis roll over or not depends largely on what the broad market does. But I think because they tend to move so much, if the broad market drops, that means tech is going down. And if tech goes down, it will drag the semis down with it. And last one up, GBTC. I mentioned the other day we had our stop just clipped on this one, but I still like it. Story of my life recently with these stop raids on some of these official trades. Just went under there, but I put up a chart in the trading room today, and we'll wrap it up here with Bitcoin. Let me just show you that 60-minute. Okay, here it is. This is GXBT. These are Bitcoin futures. This is a 60-minute chart. And I did point out, we had bullish divergence here. We've continued lower, a lot like what's going on with the dollar and the euro. The bullish case, a case for reversal is still very much intact. So what we did is we undercut these recent lows right here. Look to the left of the chart. You can see this previous low, we undercut it, but now we've regained that level. That's bullish. this so far, if we can start to move up from here, this will have proven to be a bear trap or a false breakdown. So what we need to do from this point is, obviously you can see this downtrend line that I have right here. Take that downtrend line out. You can see the divergences very much still intact. And like I said, sometimes divergences don't play out at all. Sometimes they do play out. They just continue to build. So at this divergent low, we had a little pop, but it wasn't the pop. So I'm looking for potential reversal in Bitcoin that could take us up. I'll have to play around with this chart and set some targets, but it is looking pretty good right now based off this 60-minute time frame. And again, I mentioned a minute ago, GBTC is an equity option. It trades on the pink sheets. If you don't have a futures account, you can use GBTC. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.